All right, everybody. Well, welcome to today's educational class on the self-directed solo 401k plan. Thank you again for joining us. Our apologies for being a couple minutes late while we dealt with a couple technical issues getting Zoom set up. But here we are and excited. Jason DeBono, Vice President here at NuView Trust Company. And for the last 15 years, my job has been to help people understand how to use retirement plans as a vehicle to make investments outside the stock market. And historically, early on when I started, all the rage and all the discussion was around IRAs because the rules and regulations really were IRA driven. There was no 401k plan that was attractive to own real estate in. It was hard, you were part of a company plan. However, in 2008, and due to some other changes, a solo 401k, uni 401k, individual, EQRP, it goes by a bunch of different names, but in essence, a retirement plan that looks and operates like a 401k plan was created for people that are self-employed. And so what it allows is it allows us to take all the benefits of 401k plans and use it like an IRA from an investment standpoint. So we're going to walk and talk through that today. I encourage questions as we go. I've got a mouse here, so if you see me moving around or looking away, it's because I'm trying to manage both things at once. But on your screen, you should see a Q&A option. There's also a chat function. You can simply click into that, type in your question. I'll get those reviewed and read aloud. I'll pause every couple of slides and see what's coming in. But this presentation is going to be a lot more effective for all of us with as much dialogue as we can put into it. So if you have questions, please get those asked, and I will get those answered and get those addressed. So we're going to talk about what we kind of refer to as the ultimate retirement plan for people that are self-employed. So we'll talk about what that looks like and how we get there. All right, so the first thing I want to make sure everyone understands, we are not attorneys, we're not CPAs. Our job is not to be your legal or tax counsel. We are a custodian of retirement accounts. We are a plan document provider of solo 401ks, but we are not attorneys and CPAs, nor do we pretend to be. So every situation is different. We will use generalized comments today for discussion purposes, but make sure that you understand anything we discuss is application to you and your personal monetary situation, your income situation, how you get paid, whom you get paid by, and how you're structured. All of those things are material in relation to whether or not you qualify and could benefit from a solo 401k. So please don't rely on us to be more than we are, which is a good custodian of retirement accounts. Speaking of who we are, what we do, how does it work? NuView Trust, we've been in business now going on our 18th year. We service about $1.5 billion of retirement assets. That is a mix between predominantly custody of IRAs, self-directed by nature, as well as record keeping of 401k assets for the plan that we're going to be talking about today. In addition, we provide the plan documents for 401k plans that allow people just like you to go out and self-direct their account on their own. So that's not even included in that $1.5 billion of assets because we don't provide the custody, we provide the plan. So we'll talk about what that nuance means as we go through this today. One of the things that is attractive about the solo 401k is control and choice. And it's equally as attractive inside a self-directed IRA as well. But this plan is a step above if you qualify. But one of the biggest problems is we're all playing a game where we don't really have a lot of control over the outcome. So what happens for most people that are self-employed is they just don't save for retirement, right? They just simply don't save. That's the thing that we get the most. And it's because they probably don't want to put a few $1,000 in an IRA. They're not really fond of the choices. Historically, 401k plans have always been viewed as an employer plan, meaning lots of employees and lots of headaches, right? So these self-employed individuals are stuck in this kind of unfortunate place whereby they don't know what to do. Insert the solo 401k. The second issue that people have is that we don't control our investment outcome. Now, granted, every investment isn't controllable. However, if we look at what's going on in the world around us today, we're in the midst of a pandemic, right? The world as we know it is completely changed. I'm in a room by myself. Historically, this thing would be filled to the max. I had a mask on, and till right before we started the presentation. I can't go out to lunch because half the restaurants I used to walk to from my office are closed or not allowing indoor seating. I think we'd all agree the world that we know is very, very, very different. If you're a real estate investor, prices are going up. However, there's a moratorium on collecting rents, which is causing the shadow issue. There's a moratorium on foreclosures, right? There's all these challenges, yet real estate prices are going through the roof. If I click on the finance page of Yahoo, right, I'll see that the market's up again today. Now, it's had a couple bad days, but it's worked its way. And it's down from its record highs, but just a few weeks ago, it was at record highs. There's a disjoint in reality from the investment world as we know it and where we're kind of told we have to put our money into Wall Street and what we're all facing down here on Main Street and the real world that's ahead of us. So when we talk about how do you navigate that as an investor, and what people come to us is they say, I don't want to navigate Wall Street. I can't win that game. I'm happy when I make money on investments that go through the roof, but I can't make logic out of it. Our clients invest in Main Street. They go find investments that they can see, touch, and feel. And what this solo 401k does is it not only gives you great benefits from a plan standpoint, we're going to talk about that, but it's fully self-directed, which means this game, right, this idea that we just set it and forget it in Wall Street-based investments is not the game that you're forced to play. And unfortunately, most, if not all, traditional 401k plans have 6 to 12 investment choices, all Wall Street backed. That's a tough game to win in the grand scheme of things. So I want to talk about something that's critically important, because for a lot of people that are self-employed, and I'm assuming you're joining us today because you're likely self-employed or maybe have a side hustle, as they call it, right, that would technically make you self-employed for at least some or all of your earnings. But I want to talk a little bit about building wealth, because one of the things that happens when people are self-employed, and I hear this all the time, Mr. and Mrs. Smith, do you have a retirement account? No. All the real estate I own is my retirement account. And I tell them that's great. Nothing wrong with that. But what if you could own all that real estate and not have to pay tax on it? Because that's what a self-directed account can do. So when we talk about building wealth, people think investment. That's the strategy to building wealth, right? I'd be wealthy if I just bought Tesla when it was $300 before it split, right? Well, wealthy doesn't mean making great investments. That's a byproduct of it. Wealthy means maximizing the value of every investment you make, and there's an inherent difference. So I'm going to tell you a quick story, and I'm going to illustrate in numbers why this is so critically important. Most people miss out on building wealth because they overstep the taxes and they just focus on the investments. And many people would turn down a 7% investment in lieu of an 8% investment, despite the fact that maybe that 7% investment is tax-free, making the net return actually better than the 8% taxable, right? So when I talk through this, I want you to kind of take this idea. We're going to talk about this from a couple of understandings. Number one, we're going to take $1. Right? I'm going to illustrate my example of true wealth building with $1. We're going to take $1 and we are going to double it every year for 20 years. $1 becomes 2, becomes 4, becomes 8, becomes 16, becomes 32. $1 doubled every year for 20 years. And we're going to take 2 people, right? One person does that $1 doubling in a taxable account at a 25% tax bracket. And the other person does the same investment with the same dollar, but does it in a solo 401k where they're not taxed annually. And we're going to talk about the difference. So 20 years from now, the guy or girl that did that in their taxable account is going to be sitting around a table with some friends and say, 20 years ago, I took $1 and I doubled it every year, and it's now worth about $72,000. Now, everyone at that table is going to go, holy cow, you turned $1 into $72,000. That's incredible. Sounds like a fantastic deal. And it is. But just know that there's another table, probably at a nicer restaurant, where somebody is sitting around telling the same story of how they took the same dollar, made the same investment, doubling for 20 years, but instead of having $72,000, they're going to end up with $1,048,000. Now let that settle in for a second. Same dollar, same period of time, same investment. The only thing that this person did different than this person is they simply put the dollar in a tax-advantaged vehicle first. That, everybody, is the power of using self-directed retirement accounts, i.e. the solo 401k, which we're going to talk about, to make those real estate investments or to issue those private loans or whatever your investment strategy is. Because at the end of the day, the investment is only a small part of how much wealth you build. The vehicle that protects you from taxes is a large part of the wealth that you build. So I won't ask because I know the answer already, but if I were, just for the sake of discussion, who do you want to be? Do you want to be the one telling the story about your $72,000 earnings, or do you want to talk about the million plus that you earn? So when we talk about these retirement accounts and the strategies and all that behind it, we don't want you to use an IRA because it's just another way to do the same thing. We encourage people to use their retirement money for two reasons. Number one, because it's a way to do what you may already be doing in a tax-free manner. And number two, because you may have retirement money that's sitting somewhere in investments that you're not fond of that can be moved into asset classes that you know and understand. So we're going to carry that mantra through the rest of the presentation as we go through today. I've got a couple questions that popped up. Thank you for those. Let me go ahead and open that and get those addressed. All right, it says the real number tax-free would be 1 million times 25% tax or 40% tax at the end. Still, 400K or 600K is better than 70K. That's actually a really good point, and one that I was actually planning to illustrate a couple slides from now, but I'll go ahead and stop here. So what this individual rightfully points out is we calculated tax liability, right, all the way over here, but we assumed there was never a tax liability here. When it comes to retirement accounts, there are two ways to pay the tax. The choice is yours. This individual could have chosen a traditional contribution, meaning that they got a tax deduction on the dollar and paid the tax on the million. And yes, if they took it all as one lump sum, a little bit less than 40% under our current tax rate, but it would have cost about $400,000 rounding up. They would have had $600,000 instead of 72. Still a great deal. But what you're not factoring in is that this individual had the opportunity to pay the tax on the dollar up front, which is a Roth account. By paying the tax on the dollar, assuming 40% or 40 cents, that $1,048,000 is 100% tax-free. Furthering the case of building wealth is a knowledge-based decision. One, to understand that tax advantage growth is great, but to understand that tax-free growth in the Roth is the best, depending on the circumstance. So this is a no-brainer, right? Pay the tax on the dollar through a Roth account, take the $1 million tax-free. Thank you for pointing that out. It's absolutely fair, but something that there is some great workarounds for. Let's see. It says, does the million show the taxes were paid at conclusion? I just addressed that. And then it says, can a solo 401k be passed to family at death or earlier without immediate serious tax consequences? I'm going to hold off on the legacy process of 401k plans, but we will touch on that before I wrap up. If you think I forgot, please ask me again, but I will get to that. So moral of this slide is very simple. Retirement accounts, and I don't say this as being the only tax advantage vehicle. There's other ones out there. But retirement accounts are the most accessible, easiest tax advantage retirement accounts. You don't need a slew of accountants to create tax strategies and loopholes. This is basic code in the IRS. A few pages, you can read it yourself. So when we talk about building wealth, yes, there's lots of great strategies that lots of people with lots more money, than maybe all of us combined have that they deploy every day, but they deploy it through very, very strategic structures with teams managing every component. And that is good and great. And if your desire and willingness and ability to build wealth allows you to do that, absolutely do it. But what every single American can do today, regardless of their knowledge, is this. Because IRAs and 401k plans are accessible to everybody as long as you have earned income, right? So there's no better way to easily access and unlock those tax benefits. All right. So just for illustration purposes, I'm not going to go through all of these, but these are the different plans that exist in the IRA world, right? Traditional, Roth, 6,000, 7,000. A SEP gets you up to 57,000, but it's capped at 25% of your self-employed income. We're going to talk about the difference between those today. A simple 13.5, maybe 16.5, depending on your age. You can really get down and realize those are good and great, but if you want to sock away a lot of money, the solo 401k plan gives you up to $57,000 of contribution. And you get there by contributing as an employee and as an employer, just like a regular 401k, but keep in mind, you are the employee and the employer, right? So let's talk a little bit about that. So how much can you actually contribute? Well, your employee contribution is dollar for dollar against your earnings that are self-employed. So let's assume that I'll give a couple examples. Example one is I'm full-time self-employed. Now, the key here is I have no employees. If I have employees, it may create challenges to this plan. And the reason is this plan is not designed for employee-based businesses. It's specifically designed for businesses that have no common law employees. It was enacted as a way to encourage the small business owner to be able to save, because the gap for a one-owner or two-owner business without employees to move to a traditional 401k plan was too big. So there was this hole of people not saving, right? So Congress kind of created a legislation that made this possible. So it's really not designed for anyone with employees. We can talk about that, and we will here in a second. But it's dollar for dollar. So if I'm full-time self-employed, maybe I'm a consultant, maybe I'm a realtor, maybe I'm a real estate investor, it really doesn't matter. It means that I have self-employed income regardless of how I structure myself. And I'm eligible to contribute dollar for dollar, up to $19,500. From there, and I guess in addition to that, if you're over 50, you get an extra $6,500. In addition to that, my employer is eligible to make a profit sharing contribution on behalf of the plan participants, which is me, of up to 25%. So if I'm a realtor and I just make $50,000 worth of what we'll consider self-employed income, I can contribute $19,500 dollar for dollar. Then I can take $12,500, which is 25% of the $50,000, add those two together, and I can get, what is that, $31,500 of my $50,000 of income into this solo 401k fund. Now, you may be saying, well, who, if they made $50,000, would ever put $32,000 away? That's a 50% contribution rate. That's very high. Many self-employed people may have other forms of passive income that doesn't fall under self-employed income. So that realtor may own other properties or may have other passive income or losses against some of their earnings. So they may actually, on paper, show $100,000, $200,000 of income, but eligibility for this plan is only the $50,000 that's considered self-employed. What it does is it allows them to accelerate even small earned income bits to maximize their contributions. So it's something that can allow you to put a lot more money away in shorter periods of time. All right. So what is, when we talk about brokerage-based versus self-directed, so I want to make a couple things clear. The solo 401k plan, and again, you'll hear it advertised as a individual 401k, owner-only 401k, solo 401k, EQRP. There's 1,000 names for it. However, it's pretty much the same thing. Everybody's selling you pretty much the same plan. Now, they may hold your hand a little bit more, a little bit less from one firm to another, but at the end of the day, they're all the same, right? What does differ is where you get your plan from. Someone like NuView is not tied to any investment. Therefore, our plan is designed to hold any investment. Whereas brokerage firms offer these plans for free. However, the plan requires that the assets be held at that firm. So if you go open this at Fidelity, you're going to have to invest in Fidelity's, platform. So if you're looking for a broad choice, the brokerage product just doesn't work. The plan is fine. The ability to put the money in is the same, but it's going to cause you issues from the investment standpoint. So just be mindful of that. Self-direction says you have full maximum potential inside the plan for investments, completely open and unlimited. Couple other things. In these solo 401k plans, again, they go by many names, you get to be lots of the roles inside of it. You can be as many or as few of those roles as you want. What that means is that you can actually have full control to a point where you open up your own bank account for the 401k. You buy the investments for the 401k. You keep track of all the investments. You could go open a brokerage account under that same 401k, wherever you want. Basically, you have a plan, and then you manage it all yourself, and that would make you all the roles. Or you could outsource or hire third parties or delegate any one or all of those tasks along the way. And we'll talk through those here in a bit. But understand that in a plan from someone that's independent, like NuView, is going to give you the most maximum opportunity for the plan. So who's eligible? Well, we've talked about this. Anyone that has self-employed income. Now, I am not an accountant, so rest assured, I do not know every single line item on the 1040 and how it gets there. But typically, my understanding, right, as I've been told in very simplistic words, is if you're filing and paying any sort of self-employment tax, that constitutes as self-employed earnings. Right? That's one easy way to understand that. Or if you have a business, right, that collects any of the money and files tax, so whether you're an LLC, whether you're a limited partnership, whether you set up as a C Corp, an S Corp, or whether you're a sole proprietor, it really doesn't matter. It has to do with the eligibility is around how you're taxed on the dollars from a self-employed standpoint. You cannot have common law employees in this plan. It doesn't mean you can't go out and open a 401k plan with common law employees. That happens every day. But if you want the 100% hands-off, easiest plan to operate with the most open-ended benefits, you don't want employees. Because once you add employees, you add responsibilities. Because the whole premise is 401k plans are a tool for your employees. The IRS imposes restrictions and guidelines based on the behavior of that plan. Well, they want to make sure that you're treating your employees fairly, that the restrictions, are universal. If you have no employees, there's no governance on any of that because the IRS knows that if it's just you, you're going to treat yourself fairly. But if you hire me, the rules start getting layered on because they want to protect me because I'm a common law employee. So what does common law mean? Non-spouse. So, for example, if I'm Jason DeBono, realtor, I'm self-employed. If I employ my wife under that business, she is not common law. I still qualify for this plan, even though I have technically an employee. It's because she's not a common law employee. And again, she's my spouse. The IRS says chances are he's going to treat his spouse, the same way he would treat himself, so we don't have to babysit the plan. If they own 5% or more of the business, they're not considered common law. So if I were to start a business, Jason DeBono's Consulting, and I own 50%, and I hire 10 people that each own 5%, we're not common law employees. I could have this plan, everybody could participate, but I have no common law employees because everybody there is at least a 5% owner. The other way to exclude from common law status would be if they work under 1,000 hours. So if I hire someone for 800 hours, they're not part of the plan or not required to be part of the plan. So I can still have this if I have 2 part-time employees. I will pause there for questions. it says, still not clear on taxable at 25%, which grows at $72,000. Are you taxed every year? Why would that be? Great question. So if I make an investment, let's just say $1 in my personal money, use it meaning it's money that's mine, taxable to me. If I put $1 into an investment and it grows by $1, I have $1 of profit. I have to report that on my tax return for the year because it's personal income. If my tax rate's 25%, I have to pay tax 25% of that dollar, therefore I pay a quarter. So when I turn around and reinvest, I only have the original dollar plus the 75 cents left that I earned. That $1.75 gets invested next year and becomes $3.50. I have $1.75 of profit. That $1.75 of profit goes on my tax return because I made it during the year. I pay tax on that $1.75, whatever that equates to at 25%, and so on and so forth. So yes, every investment you make that is in your personal name, as a general rule, is taxed as you make profits, right? So you have to really be careful from an investment standpoint. Not be careful. Making money is a good thing. But if there's a way to put that asset simply into a vehicle that's not taxed, that can provide you some benefits, right? So hopefully that clarified that for you. Let's see. I have a client who has their own business, wants to offer 401k to their employees, already using ADP for payroll, but not sure if they should continue with ADP. Do all plans have monthly admin costs? That may be a question that we want to take offline. When you start getting into plans with employees, that actually gets beyond our scope. Typically, companies that offer plans that cover employees are more plan administration firms. We're an IRA custodian, so I may be able to answer that offline, or if you want to put a little more clarity to that question, but I'm not 100% sure what you're looking for there. Let's see. Will there be a playback? Yes. It will be posted on the blog section. I believe it'll be emailed out to each of you as well. All right. It says, I have money in savings that taxes have been paid. If I open one, will it be taxed again? The answer is no. You're not taxed by making a contribution. It's all taxed in the year in which you earn the money. So if you were to put $5,000 into your Roth IRA, if you've already paid the tax on those dollars, you don't get double taxed. It's taxed only one time. Let's see. For 2020, when is the last day you can make a contribution? So great question. For 401k plans, they work different than IRAs. There are 2 contributions to 401k plans and 3 deadlines. First, the plan must be established in the tax year in which you plan to contribute for. So you cannot create this plan for the previous year. IRAs, you can. 401ks, you cannot. So it has to be established by 12/31. The employee deferral has to be, the employee's portion, that $19,500, has to be contributed in the year in which you make the money. So obviously the last day I can earn money for 2020 is December 31st. So the IRS gives you a very small window, like a week, maybe 2 weeks, to contribute, to put that in against my 2020 earnings, but it's very, 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 very little time. So it's your contribution really as easiest to view as 12/31, it's a calendar year. The employer deferral, that 25% profit share, is not due until the employer's tax filing deadline of the following year. So the employer actually technically has until October 15th if they file for extensions to contribute for the previous year. So you've got some options there. Age limit, I am 69. So typically in retirement accounts, 70.5 is in a traditional IRA is when you're ineligible to stop contributing. There is no age limit in a solo 401k as long as you have the earned income to justify your contribution. So if you're 69 but still working, you can still establish, with self-employed income, you could establish this plan and make annual contributions. All right, question says, can you have more than one solo 401k plan if you own more than one business? Also, if yes, can one be a Roth even if the other one is not a Roth? So the answer to this is yes, with an asterisk, and this is something that If you have multiple businesses, you really need to understand what that means. So there's a couple things to be aware of with multiple businesses. So first, let me start with, I'll use an example for me. I'm an employee here at NuView. Any of my NuView earnings are not self-employed, right? Therefore, I'm not eligible to contribute to a solo 401k. However, I have a 401k here at NuView, and I contribute to that. On the side, right, if I'm a realtor, a consultant, it doesn't matter, but I actually have self-employed income. I can have my NuView 401k plan and my consulting business 401k plan. However, the maximum contribution is the combination of both. I can't max out my NuView one and max out my consulting one. So typically having multiple 401k plans isn't a benefit. The only reason I would have two in this scenario is one is through my self-employed income and one is through my employee income. And there may be some benefits to get more into the profit sharing side, but the employee side typically is going to be the same. If you own multiple businesses, then you need to look up the requirements on a term called a control group. A control group means that the IRS says, hey, if you own 4 businesses, majority owner, depending on how they're set up and structured, we may just treat them all as one under a control group setting. So there's some nuances there. It's pretty technical to get into. As long as you don't have employees in any of the other businesses, it's not going to cause you any issues. What could cause you issues if I own company A with 20, full-time common law employees and company B with no employees. Typically, what I cannot do is they don't want me setting up this full-blown 401k plan for company B for myself and not doing something to cover my actual employees because I'm shared ownership of both companies. So something to be aware of when it comes to controlled groups. All right, it says, I have a 401k with my job and an IRA outside. Is it recommended to keep both? The short answer to that is typically yes. It generally never makes sense to have any more money with your current employer than what you contributed with that current employer. And the reason is 401ks are very limited through employers. You're under this big group and they make all the rules. So for example, if I work at AT&T for 10 years and save $100,000 and I leave, and I go to Sprint, it is generally not a good idea to take that $100,000 from AT&T's 401k and move it to Sprint because I'm going to have to live under Sprint rules. I'm better off taking the $100,000 to an IRA, then I can live under whatever set of rules I want. I can invest in every available investment, even if it's just public securities, I still have that access. Whereas if I take it to Sprint, it's under their rules. So you typically should only have the amount of money, the minimum amount you're required to keep with your current employer, which is what you've contributed through them. Everything else should always be moved to IRAs because you just have more control. Now, if you like the investments, you're going to put in one mutual fund and set it and forget it forever, then it may not matter to you. But I would imagine if you're on this call, that's probably not your intention. So yeah, generally never take money from an old 401k or from an IRA and move it to a 401k unless there's some very strategic reason behind it. As far as a self-directed IRA, there's a question here and it says, can I open a self-directed IRA if I have self-employed income? I want to be really clear. You do not have to have self-employed income to have a self-directed IRA. You do have to have self-employed income to start a solo 401k, completely different plan. So if your intention is to focus specifically on a self-directed IRA, none of the things I'm talking about with common law employees are material. Everybody, if you have retirement savings somewhere, you're automatically eligible for a self-directed IRA. There's no requirement there, right? Any earned income gives you eligibility to add money to an IRA. Self-employed income is required to add money to a solo 401k. So hopefully that clears that up. This is an interesting one. I have to say, in 15 years, I've never gotten this one before, and it says, what strategy should be used for a musician? I don't know what that means. I am probably the farthest from musically inclined as you could ever imagine, but I guess I'll answer it under this supposition that you're a musician that's self-employed, you probably book gigs, maybe partner up with bands and other things, so your income is self-employed. If your goal is to put money away, you're self-employed just like anyone else that's self-employed. The fact you're a musician versus an accountant versus a property manager doesn't matter. If you're self-employed, I always recommend people consider the solo 401k if they're self-employed because it's the best plan out there. But it doesn't mean it's the right plan for every one of you that's self-employed. There's a big difference there. But this is where you should start because it maximizes contribution, gives you the most flexibility and control. So hopefully that answered that question. Can you still contribute $6,500 to a Roth if you contribute to a solo 401k Roth? The general answer here is yes. So having a 401k does not preclude you from contributing to a IRA. What can happen, depending on your income and the type of IRA and how much you contribute to your 401k, there may be some tax concerns where you may not get a full deduction or some of the same tax benefits. That's really an accountant question. But yes, I, as an employee of NuView, have my 401k here, and I still get to contribute to an IRA should I choose. So a lot of opportunity there, and I love the Roth combo. That makes great sense. All right, it says, what if I have one company with a solo 401k plan for me as owner and one for my spouse who is not the owner? If my wife owns another company, will those two companies be considered a controlled group? The first company would have no employees, the second company would. I don't know the answer to that. I'm not certain as to whether or not your wife's ownership of a different company would make it a controlled group. And I don't want to speculate. I just don't get that deep into the eligibility of the actual plan. So that is an accountant question. If you do want to reach out to me, I can give you some recommendations of accountants that we know that are pretty familiar and have helped a lot of our clients set these plans up. All right, will you have some documentation on this plan we can send to our accountants? Yes, we can. We'll send some information out. You can email me directly. I know who you are, and we can get you some stuff on that. Let's see. It says, can you contribute to a Roth solo 401k and a non-Roth solo 401k in the same year? Yes. So what that question is asking is, the way that the Roth and non-Roth works is, in a solo 401k, the $19,500 employee deferral is in each employee, which is really you, has the decision whether to contribute that money via Roth or non-Roth. The total of both of them cannot exceed $19,500. So I cannot put $19,500 in a Roth and $19,500 in a traditional as an employee. What I could do is put $10,000 in a Roth and $9,500 in the traditional. But as long as the combined contribution against that solo 401k employee deferral does not exceed $19,500. Same thing if I'm an employee of NuView, right? I have my NuView 401k, and I have, actually, let me give you a very real strategy that I've seen people deploy. So I work for NuView. NuView has a company match on our 401k plan. Well, of course, I want to contribute as much as I can to get that match. If they match 3%, 5%, 7%, I should be contributing that at a minimum because that's 100% return on every dollar I put in. It makes great sense. But I may not want to put $1 more, right? If I work for AT&T and I've only got 7 investment choices in the plan, why subject the dollars where I'm getting no added benefit from the employer to a small list of investment choices? So if I'm covered under AT&T's plan and I'm covered under, and I create my own solo 401k for my consulting business that I run on the side, what's really cool about this is my $19,500 I can split between the accounts. So if my employer will match up to $5,000 a year, I can put $5,000 into that plan through AT&T. They'll match my $5,000. That's a fantastic deal. Then I can take the other $14,500, which gets me to $19,500 total, and contribute that over here into my solo 401k. Because if all things are equal, I get no benefit. I'd much rather have the dollars in my solo 401k that I have 100% control over than in AT&T's 401k plan where I have no investment choices and no control. So hopefully that makes sense about how to strategize between these plans. All right, can I transfer to a solo 401k all of my contributions from previous plans? I have had a number of other jobs which still have IRAs and 401ks. Great question. The solo 401k can accept money from any 401k and any non-Roth IRA. I don't know why it doesn't allow Roth IRAs to be rolled into the solo 401k. That just has, the Congress and the IRS have never opened that door. But to give you an example, let's say I have two old 401ks from previous employers and a Roth IRA and a traditional IRA, and I'm self-employed. I start a new solo 401k today. I can transfer the two old 401ks into that plan. I can transfer the traditional IRA into that plan. I cannot move the Roth IRA into that plan as of now, and it's been years. And they still haven't opened that window up. Not sure if they will or ever will, but as of today, you cannot move Roth IRAs into 401k plans, but all other plans, as long as they're portable, can be moved in. All right. It says, I just started a side hustle. I didn't incorporate. Do I need to incorporate for my side hustle to pay me through in order to qualify for a solo 401k? So let me answer that question first. So the answer is it depends. So it doesn't matter whether you incorporate or not. Sole proprietors, meaning unincorporated, can still be considered self-employed. What matters is how you report the incomes on your tax return. If you take the income from the business and report it as passive business income or passive earning, it's not eligible. If you report it on your tax return as active self-employed income and you're paying self-employment tax, then it is eligible whether you incorporate or not. So the incorporation may be easier to make it eligible income, but it's not required to be self-employed income. So hopefully that answered the question. As far as what should I set up, a self-directed solo 401k or self-directed IRA, excuse me, the question is, it depends. The solo 401k plan, if your goal is to put money away and have maximum control, it's the best plan because it has the highest contribution limit and the most control. But if those aren't your intentions, so for example, we have thousands of clients. I have a client, right, lots of them, that they just want to make one investment passively. They don't want to do anything. They already have the money in a retirement account. They want to transfer it, and they want to be hands-on. In that case, the IRA is a much better plan. They're not adding to it. They already have other means of contributing. They're taking 50 grand, 100 grand, making one investment. They just want to hold it, right, collect the rent, collect the mortgage payments, whatever their investment is. Then an IRA is a great strategy because it's the most hands-off. So it really has to do with what are your goals. The more control you want, meaning the more you want to touch the dollars, control the paperwork, and manage every step, and the more contribution eligibility you want, the more favorable the 401k is. If you just want a vehicle that you don't need to add money to and you just want to passively make some investments and you want to let NuView kind of handle more of the work and effort from a paperwork standpoint, and you just want to find investments and move on, then the IRA may be a much better choice for you. So it is very situational dependent. Can a self-directed IRA be converted into a self-directed 401k without penalty? Yes, per my discussion earlier, as long as it's not a Roth. Roth IRAs cannot move to solo 401ks. Everything else can. No tax, no penalty. Let's see. Can you open a 401k for employees an IRA for employees as opposed to a 401k? Also, be able to get info documents on solo 401k, SEP, KEO, and do you prefer one over the other? Would any of these work for small businesses trying to open a plan for employees? I'll touch on this one. If you want, when you have employees, common law employees, meaning you no longer qualify for the solo 401k, there are really two primary options we see people go with. For small businesses less than 100, there's a simple IRA that may allow you to put contributions, or it does allow your employees to contribute and you to contribute on their behalf. The other plan would be a regular 401k, which is designed to cover employees. Our plan does not cover employees for all the reasons I mentioned earlier. Yeah, just for clarification, somebody asked for clarification on the employee-employer situation. Even if you're the owner, you're still an employee. So being an owner doesn't mean you're not the employee. You're just not a common law employee by virtue of being the owner. So every business has an owner and an employee. They may be the same person. That's how you get the 20 as an employee and the 40 as the employer to cap out at that $57,000 or so that we talked about. Great question, and I'm going to take this one and the next one, and then we're going to get wrapped up here. I got a couple more slides I want to talk through. The question says, if I get a check on December 31st, can I contribute against those earnings even if I got the check the 31st but didn't deposit it till the next day? And the answer is yes. The IRS gives you a very small window. It's not defined in code, but there is a small window. So, for example, if you're an employee and you get a bonus check on 12/31, well, of course, the IRS doesn't expect you to contribute to your 401k in real time. But what they wouldn't do is, if you got the check on the 31st of December, you couldn't wait till February 1st and say, oh, I'm going to make my deferral to my 401k plan as an employee. So what we typically hear from people that deal with this all the time is 2 weeks maximum. So, most people suggest the sooner you do it, the better. So, you shouldn't be contributing as an employee much more than a week or two after the end of the year because you know what your earnings are. The reason the employer gets more time is that's a business decision. They want to get the business time to clear the books before deciding how much profit to share with eligible employees, and that can take months. So big distinction there. Great question. All right, it says, can you, and this will be the last question until we get towards the end, can you eventually move solo 401k monies into a self-directed Roth later? Absolutely. So we have a lot of clients that they'll set up a 401k, solo 401k, they'll actively contribute to it, right? And then they get to a point where maybe they don't want to make as aggressive of contributions, right? They now stocked a good amount of money away and they just want to kind of passively invest that into non-public investments. A self-directed IRA is perfect for that. You can roll that over at any time into an IRA. All right, I'll come back to the last few questions, but I want to make sure we get through our slides here. First of all, thank you very much. I love questions. I know there was a couple comments about, can we pause on questions? The questions are actually the easiest way to understand this plan specifically, so I do like to cover them as we go through it. I'll highlight some stuff that we haven't covered, but the questions are very good, and I genuinely appreciate those. Please keep them coming. We'll take them at the end as long as we can. All right. So we talked about eligibility. So we've mentioned this already, but how do you fund it? Well, the first way to fund it is by moving money in from previous qualified plans, 401ks, 403bs, 457s, your savings plans, basically plans through your employer, whether that's the government, state or local municipalities, or privately employed, right? The second one is to all IRA plan types except the Roth. So all IRA plan types can go into the solo 401k, but not the Roth, unfortunately. And then the last thing is annual contributions. If you are setting up a solo 401k and not contributing to it, that's generally going to be a problem over time. Because the IRS says, why are you creating this 401k employee deferral program if your employees are never going to contribute to it? So there are some times where people will set it up for some, to make a quick investment, but as a general rule, you don't want to go more than a few years without making some nominal contribution to this plan. Otherwise, why have it, right? And why give the IRS the ability to question why have it? So let's talk about some benefits. So these are some things that we haven't discussed that are some big benefits. Some of these are just general benefits. Some of these benefits compared to the IRA. Again, benefits are in the eye of the beholder, right? Having an accelerated contribution may not mean much to you if you're not putting more than a few $1,000 in your retirement account anyway. So some of these, again, are in the eye of the beholder. Number one, accelerated contributions. We talked about that. You can get the most money in with the lowest level of income versus any other plan. Secondly, the highest amount of Roth contributions. Right now, a Roth IRA is capped at $6,000 or $7,000 depending on your age. That's not a lot of money. But in the solo 401k, it's $19,500. So you can contribute nearly 3 times the amount into a 401k Roth than you could into a Roth IRA. The other thing is there's no income restriction on a Roth contribution to a 401k. So as of today in an IRA, and I don't know what the exact number is, but if you make over like 180 grand filing jointly, a little over 100 filing singly, you can't contribute directly to a Roth IRA, but you can contribute directly to this. There's some backdoor ways to get into a Roth IRA if you're over the income limit, but you don't have to go through those steps. Asset diversification. Traditional and non-traditional. This is a major benefit of solo 401ks if you like stocks and non-stock investments. So typically what in a self-directed IRA world, which most people do, is they have an IRA at a brokerage, Schwab, Fidelity, Merrill, where they buy their public securities, and then they move whatever they want in alternatives to someone like NuView, because none of the custodians in this business are great at stocks. We all kind of offer it, but that's not our business. So you go over here to Fidelity, where they have a great trading platform, and you come to NuView, where you've got a great alternative investment platform. In a solo 401k, you can actually have one plan, one 401k, and then you can put that money into traditional and non-traditional investments under one umbrella. So you can go open your own brokerage account at Fidelity and open your own and go own real estate all under the same plan with the same signatory, whereas today you got to move that into typically different plans. So it's a very interesting opportunity. Personal loan provision. IRAs cannot be borrowed by you as an individual. Yes, there are some 60-day windows. It's a little bit longer with the CARES Act. That's not a loan. That's simply taking money out and putting it back. A loan is where you actually borrow it under financial terms and pay it back over those terms. So the beauty for those of you that are self-employed is if you're really socking money into this, and maybe your business has a hiccup, or maybe you need to inject 20 grand of capital into your business, but you don't have the money. You can borrow up to 50% or $50,000. It's actually up to $100,000 with the CARES Act right now. You can borrow that money, use it for whatever you want, and pay it back over the terms of the loan. Typically, it's 5 years, 10 years if it's for a primary residence. So that's a little savings vehicle that can also be tapped into personally. And we've seen a lot of people put more money into their 401k knowing that if things went bad, they had access to it. So that's a really, really cool safety net and a cool part of the plan. It's not subject to UDFI taxes. So IRAs for all your investments, as a general rule, are not taxed. However, in the IRA world, if you go out and take on a loan, meaning your IRA gets a loan to buy real estate, which can be done, if you do that, you subject the account to a tax called UDFI, unrelated debt finance income tax. So for anyone that's investing in any sort of leveraged real estate deal in an IRA, it's taxable. It's not a bad thing, but it's still taxed. If we can avoid it, let's avoid it. This plan, not subject to the same tax. So if you make that plan in the 401k, you don't have to pay the tax. Same investment, no tax. So again, that's a strategy-specific reason to have the solo 401k, but certainly can be a very big saver from a tax standpoint. Check writing ability. So in a solo 401k, you automatically have checkbook control. You can open your own bank account under the name of the 401k plan and go operate. In an IRA, you don't have checkbook authority. You can set up an LLC and go through some hoops to get it, but it's not automatically designed because the custodian is required to make investments on your behalf. In a 401k, as the trustee, you get to make your own investments. So lots and lots of great benefits as it relates to that as well. So lots of things to look at. The rules for what you cannot do actually mimic or match the IRA rules. So you cannot use the self-directed solo 401k to purchase life insurance or collectibles. Now, I put a little asterisk there because there are some 401k provisions for life insurance. I'm not an expert, but if you did have some desire to do that, understand there may be a provision that goes beyond the IRA limitations, but no life insurance, no collectibles. The second rule is that your 401k has to stay at an arm's length. That means that any investments that you as the trustee make in your 401k cannot be to yourself or to your business or to most family members. They want that 401k as a tax-advantaged vehicle to make arm's length investments, and they don't want certain parties to be part of those transactions for fear that it won't be arm's length and that you'll do a sweetheart deal, which is probably a pretty true statement. So what are the things we see our clients doing in these accounts? I mean, a little bit of everything. But these are the kind of Main Street type investments our clients make. Real estate, mortgages, notes, private stock, LLCs, debentures, public stock. The world is your oyster as long as it's not a life insurance product or collectible, and as long as you're not doing business with most family members, you can make any investment that you deem or deem reasonable for your plan. So let's pause there. I know we've taken a ton of questions already. I've got about 5 minutes left, so I will take as many more questions that come in that time frame. So let's see here. All right. So if my accountant says I can likely contribute $65,000 to a solo 401k for 2020, if I wanted to put part of it in a Roth solo 401k and part in a non-Roth, the total number of both types 401ks could not be more than my personal 65K limit. So let me break this down. So I'm going to take the 65, I'm assuming you're over the age of 50, right? So that's where you're getting a little bump. So so my numbers may not match yours exactly, but the idea is the same. 401ks have two different types of contributions. They have an employee deferral, which is capped at 19.5 or 26, I think, if you're self-employed. Sorry, if you're over 50. That portion is the only portion that can be split traditional or Roth. That is your choice for each dollar you put in. So you could do 100% Roth, 100% traditional, or some hybrid, so long as the total of that 19.5 does not exceed 19.5. The employer portion is always pre-tax, always. That means that the employer always puts it in under a tax-deductible manner. You cannot put the employer portion in as a Roth. So the most you could ever get into a Roth from a contribution standpoint is 19.5. But here's something that I'll just put a nugget out there for you to consider and think about is the beauty is inside this plan, you can do a Roth conversion, which means after you make your contribution, 19.5 to your Roth and the rest to your traditional, the very next day, you could choose to convert your pre-tax money to a Roth. You're going to have to pay the tax on the amount you convert, but it allows you to put more money into the Roth. It's just not directly through contributions. It's indirectly through Roth conversion. So we can talk about that offline, but the sky's the limit on getting money into Roths so much as you can use Roth conversions as a tool. It says if your solo 401k is invested in commercial property and you convert the plan to an IRA, does this trigger additional UBIT or other costs upon the sale of that property? My understanding is yes. So meaning if you have a leveraged piece of real estate, which is what triggers UDFI, if you have a leveraged piece of real estate in your solo 401k, the earnings annually are not subject to the tax because it's not taxed and the earnings are going to the 401k. If you decide to roll out of that 401k to an IRA, going forward, the earnings from that point are now subject to tax, and then the sale will be subject to tax because it didn't occur in a 401k. So as a general rule, I cannot think of any scenario in which you'd actually roll out of a 401k while you own debt leveraged real estate. Generally, you'd hold on to it till you sold the real estate, then roll the cash and avoid the taxation. If I had self-employed income for 2019 already filed without opening or contributing to a solo 401k, could I open one now and refile? The answer is no. You cannot go backwards in a solo 401k. If you did not establish the plan and contribute as an employee in 2019, you cannot start it in 2020. There's no do-over provision. So you can start one in 2020. What you could do if you had self-employed income is you could open a SEP for 2020. You're only going to get the profit sharing portion, which would be 25% of your self-employed income. You'd have to amend your taxes to report it by October 15th. But yes, you could do a SEP for 2019 still. So there is a look-back provision because it's an IRA. The difference between the SEP is it's only 25%. It doesn't have that 19.5 employee portion. So, but that said, it's still a way to get money in for the previous year if you did in fact have the self-employed income. I'm not sure what the question says. It says, are there any tax advantages? And the answer is yes. It's tax advantage just like any traditional or Roth account would be. Pay the tax at the beginning or pay the tax at the end, not in between. Kind of a follow-on question. It says, can I exclude any employees that work less than 1,000 hours? The answer is yes. They are not considered common law if they do not work more than 1,000 hours. As far as the tax change or the code changing to 500 or less, I just don't know that. I'm not familiar with that, but it very well could be, and something I'll go look up after this just for my own knowledge. So the solo 401k can be traditional and or Roth, yes, but only the employee contribution. The employer contribution is always traditional. What is the financial benefit of a self-directed 401k? I'm not sure I understand the context. I think I've given you lots of benefits. All of those tend to have financial benefits: no UDFI tax, putting more money away, more tax advantage growth, more investment choices. Those are all financial opportunities that the plan permits. If I left an employer last November, I still have a Roth 401k sitting with them. Is there a time limit I have to move it to a solo 401k? The answer is no. So you would have to start a 401k and be eligible. So if you are, you could open your solo 401k today, and you could move that money over. If you waited till next year to do it, it wouldn't matter. Transferring money has no time limit from the time you leave the employer. Can you flip properties in the self-directed Roth 401k, or must it be long-term rental? Yes, you can absolutely flip properties inside a solo 401k or Roth IRA or any other account. The thing that accountants kind of are cautious of is if you flip it where you look like you're running a business, you could trigger some tax. I've never seen it happen. It's theoretical at this point, but it's at least out there. But yeah, there's no issue with flipping, and flipping makes great sense. I mean, obviously it's tax-free. So short-term, tax liability should all be done in an IRA to eliminate that tax burden. Do you have an illustrated example comparison? I don't know what that means. You can take a look on our website. We have lots of information there, but as far as an illustration example comparison, I'm not sure what we're comparing. If you're deciding, let me wrap up with this because that's all the questions that I've gotten. So, and I do need to wrap up. So I first want to say thank you very much. This has been one of the most delightful presentations from a question standpoint because so many good questions were asked, and I do genuinely appreciate that. The first decision that I would encourage each of you to make is, what do I want to invest my money in? Where do I find the best opportunity for me to invest? Because really, the reason that you would be considering the self-directed solo 401k or the self-directed IRA would be because you want to give yourself more investment choices. If that's your desire, then the real question becomes not should I do it, is what's the best vehicle to get there? And I know I talk a lot about the solo 401k. Obviously, that's the presentation today, but there's lots of other plans. And it may not be a one-size-fits-all. So I would encourage anyone that believes self-direction is the right thing, they just don't know the vehicle, get on the phone with our team. I'm happy to talk with you. Give us 15, 20 minutes. Give us some insight to what you're doing. We're not advisors, but we're smart about these plans. And we can help you understand why you would consider one over the other, why you may consider having both an IRA and a 401k. We have clients that have 4 and 5 different types of accounts with us because it fits their desires and structure. But the key question is, do I want to make investments more into Main Street versus Wall Street? If that answer is yes, then you need a self-directed account, and NuView is going to be your best source for that. Whether it's the solo 401k or an IRA or some hybrid approach, give us a chance to walk you through and talk you through that process so you can make an informed decision. So with that said, I want to thank you guys all for your time today. I genuinely enjoyed our time together. I look forward to the day when it's back in person and online so that at least the local people here to our office can help fill the room. It makes it a lot easier for me than staring at a camera up on the wall. But I do appreciate the time today. If you do have follow-on questions, our contact information is all on the website. Certainly reach out to us. But thank you all very much, and take care. Hopefully we'll see you on some future educational events.